Hello everyone. Today I bring some important information on the effect of crude oil prices on the share market. So let's start with Jaydeep B. Vadher. The relationship between crude oil prices and the stock market is complex and can vary depending on several factors, including the overall economic environment, the sector in question, and investor sentiment. Here's a detailed breakdown of how crude oil prices can affect the stock market. 1. Impact on energy sector stocks. Direct correlation. Companies in the energy sector, particularly those involved in oil extraction and refining, like ExxonMobil and Chevron, often see their stock prices rise or fall in tandem with crude oil prices. Higher oil prices generally lead to increased revenues and profits for these companies, boosting their stock prices. Investment attraction. Rising oil prices may attract more investment into energy stocks as investors anticipate higher future earnings. 2. Impact on consumer discretionary sector. Cost of goods. Higher crude oil prices increase transportation and production costs, which can lead to higher prices for goods. This can reduce consumer spending, impacting companies in the consumer discretionary sector, like retail and travel. Profit margins. Companies that rely heavily on oil for production may face squeezed profit margins, leading to lower stock prices. 3. Inflation and interest rates. Inflationary pressure. Rising oil prices can contribute to overall inflation as transportation costs rise and goods become more expensive. Higher inflation can lead to increased interest rates as central banks attempt to control inflation. Cost of borrowing. Higher interest rates can negatively impact corporate profits and consumer spending, leading to potential declines in stock prices across various sectors. Economic growth indicator. Fluctuations in oil prices can be indicative of economic growth or decline. You see, rising prices may signal strong demand, which can boost investor confidence. On the flip side, falling prices may indicate economic weakness, leading to sell-offs in the stock market. And let's not forget about global events. Geopolitical tensions that affect oil supply, like conflicts in oil-rich regions, can lead to volatility in oil prices, impacting market sentiment and stock prices. Exchange rates. Countries that are major oil exporters, such as Saudi Arabia, Russia, and Canada, may see their currencies strengthen with rising oil prices, which can impact stock markets positively. Conversely, oil-importing countries, like Japan and India, may see their currencies weaken, potentially leading to negative stock market sentiment. Investor sentiment and speculation. Market psychology can be heavily influenced by oil price movements. If investors believe that rising oil prices will lead to economic downturns, they may sell stocks, leading to declines in the broader market. And then there's speculative trading. Traders may engage in speculative activities based on expected changes in oil prices, which can create volatility in stock prices, regardless of the fundamental factors. While there is often a correlation between crude oil prices and stock market performance, the nature of this relationship can vary by sector and depends on a multitude of external factors. Investors need to consider not only the immediate impacts of oil price fluctuations, but also broader economic conditions and market sentiment when assessing their potential influence on the stock market.